We are covering the sale of a partnership interest, a topic the exam tests through multi-step calculation and character of gain questions. Generally, a partnership interest is a capital asset, and selling it results in a capital gain or loss. However, the exam's complexity comes from a critical exception known as Section 751, which deals with so-called hot assets. For exam purposes, you must remember that the gain on sale is not always entirely a capital gain. Part of it can be recharacterized as ordinary income. The first step in any exam question on this topic is to correctly calculate the partner's adjusted basis in their interest, often called their outside basis. This is a common trap. The exam might only give you the initial cash contribution. You must remember that a partner's basis is a moving target adjusted each year by the items on their Schedule K1. Basis increases for their share of partnership income and additional contributions. It decreases for their share of losses and any distributions they receive. For example, if a partner contributes $50,000, is allocated $20,000 in income over 2 years, and takes $5,000 in distributions, their adjusted basis is $65,000. Once you have the correct basis, you calculate the total gain, which is the amount realized from the sale minus this adjusted basis. Now, we address the main challenge, the character of that gain. Section 751 requires the selling partner to treat the portion of their gain attributable to hot assets as ordinary income. Hot assets are primarily composed of unrealized receivables and inventory items. Think of it this way. The rule prevents a partner from converting income that would have been ordinary if recognized by the partnership into a lower taxed capital gain. The exam will give you a scenario. A partner sells their interest for $100,000. Their outside basis is $65,000, so the total gain is $35,000. The question will also state that the partner's share of the partnership's unrealized receivables has a fair market value of $15,000 and a basis of 0. This $15,000 represents the hot asset portion. Therefore, of the $35,000 total gain, $15,000 must be reported as ordinary income. The remaining $20,000 is treated as a long-term capital gain, assuming the holding period is over 1 year. The partnership itself has a reporting duty here. When a sale involving Section 751 assets occurs, the partnership must file Form 8308, Report of a Sale or Exchange of Certain Partnership Interests. This form notifies the IRS and the selling partner of the amount attributable to hot assets. To keep this straight for the exam, use this simple phrase, your U and I are always ordinary. The U stands for unrealized receivables, and the I stands for inventory. These are your hot assets, and the gain on them is always ordinary income. Remember the two-step process. Calculate the total gain using the properly adjusted basis, and then carve out the ordinary income portion related to hot assets. That's how you'll get the question right every time.